Welcome, Wes Gray, Marine Corps veteran, founder of Alpha Architect, and one of the most influential voices in quantitative investing. And by the way, one of my favorite one. To our listeners, I'm Jack Lampard from ETFatlas.com, home to the world's largest ETF database, featuring over 10,000 funds from the US, Canada, and Europe, all under one roof. Wes, your journey from combat zones to financial frontiers is extraordinary. Let's start there. How did your military service shape your systematic approach to investing, and why does Alpha Architect prioritize empowering through education in its ETF designs?
Yeah, so on your first question, basically in the service or in the military, you're often in like situations where there's a lot of chaos, a lot of stress, and you quickly learn that if you don't have a process or a system, you're gonna die, right? I mean, it's just so obviously, you create what they call standard operating procedures, because what that allows you to do is just rely on a set of rules that prevent you from doing stupid things when you're stressed out. Now, obviously, it's not the exact analogy because you're not going to die in the financial markets. You might feel like it. You're not going to physically die, but you might lose a lot of money or get destroyed on a stock trade or whatever. So it's kind of analogous in the sense that the stock market is a situation where often people are very stressed out and they get very emotional. So we probably want to identify processes and procedures up front that outline good ideas that would seem to make sense. So when we're engaged in quote unquote combat, but now we're in like the market combat, we're not doing stupid things, right? So that's basically how, I've kind of leaned a lot on our military backing of systems to avoid bad decisions and chaos and done in the financial markets. So that was your first question. And then your second question, remind me again what that one was?
So basically, I was just asking that how did your military service shape your systematic approach to investing? And now you say that you are actually, that's what's written on your website, empowering through education.
Oh yeah, exactly. Yep. So that was kind of idiosyncratic to myself. So we started about 15 years ago, and just personally, I don't like being sold junk, having like used car salesmen yell at me and like try to insurance people trying to jam overpriced things to me. And so when we started the firm, maybe it wasn't a great idea, but it's just how we did it. I just personally hate like being sold things, right? Like I'd rather like learn about stuff, understand like education, understand the process, understand what people are doing. And then I'll buy it if I think it's a good idea, right? So that's why when we started our firm, the mission was not raise as many assets as possible or make as much money as possible. It was just something that I've always believed in, which is just education and learning about stuff. And so our firm mission is to empower investors through education, because the idea was like, hey, we're not going to be like an aggressive sales firm. We're going to be an aggressive education firm. And then by nature, that'll kind of attract people, some of them, hopefully, to our products, where our products are aligned with the mission of education and transparency. And we think hopefully good ideas. And then, maybe people will be attracted that way. So that's kind of why we did that. That was just related to my personal preference to not be like the normal financial services firms.
All right. Correct me if I'm wrong, but it seems like your firm is veteran owned with team members from the US, Navy, Marine Corps, Army. Was it intentional?
Not really. It's just how it worked out. So, one of my best friends, and I went to college with him, Pat Cleary, way back in the day. Like he was a, Harvard MBA, Marine Corps captain, was doing BCG consulting, like doing kind of like the standard thing that, fancy people do. And I don't know, he was getting burnt out. This was way back in 2012, 2013. And, he was not liking his life because he had to travel all the time and it wasn't really what he wanted to do when he grew up. And so he's like, hey, I see you got this business started. I would love to be involved. I'll do ops. I'll do whatever you want. Like, this sounds great. And so it just worked out. And then, usually Marines are like very like regimented checklist, which is perfect for ops. So that worked out. And then another guy on our team, Dave Babalak, he was just he's much older than us. He's an old Army veteran, and he just found out about us in the early days, and he was a client, just a personal client of the firm. And then we needed some capital at some point when we launched our ETF business. And so we just asked them, and, a lot of times people in the service, there's kind of like a shared trust, like bond where you kind of just trust people a lot more because you've been through like a similar experience. And so he gave us some money to basically help seed up our ETF business initially. Right. And so it's the same thing. Like, I don't know why, but just, we just kind of got attracted, or people got attracted to us because we had like this shared experience with the military, and it's just how it happened. Human relationship connection situation.
Yeah. In one of your blog posts, you argued that quantitative investing mitigates human bias. Yet, even quants, they may face challenges like, for example, overfitting and many others. How does Alpha Architect balance innovation with robustness in factor design?
Yep. So I think the key thing is whenever you want to try to minimize decision making in the heat of battle, right? And because that's where it's most likely you're going to do something stupid. But to your point, someone's still got to make decisions when you're not in the heat of battle, when you're like building the process, building the plan, what have you. And, even if you're sitting there, with your quant computer, all your tools, someone's got to figure out like, well, if we're, how are we going to invest? Are we going to do momentum? We're going to do value. We're going to do whatever we're going to do. So, again, high level, we just like to make sure that we do that process when we're in a calm situation. And then we use that process in chaos situations, right? So now, and then to your question of like, well, how do we determine what is robust, what is not data mined, and what have you? That's a hard question. And I don't know the answer. I'll just like, my philosophy is I like to keep things as simple as possible because I believe simplicity prevents you from going down the rabbit hole of overfitting, over complexity, maybe thinking you found something that you didn't actually find, but you data mined it. So I'm all about simple, and I'm all about first principles and evergreen, right? Which is why we kind of focus on things that they're not. Everybody knows about value investing, right? Everybody knows about momentum investing. So it's not like we're doing things that are unknown, and that's on purpose because I want, thousands of researchers and thousands of people to vet these concepts, argue about them thoroughly, because a lot of times that just gives me confidence that, well, the reason these things probably work or don't work, it's been vetted and they're well understood phenomenon, maybe not perfectly, but a lot of people kind of generally agree on a consensus. That's where we like to focus. And then within that, just keep it as simple as possible.
You mentioned about value and momentum, and you have two ETFs made by Alpha Architect, QVAL, quantitative value, and QMOM, quantitative momentum, and they have delivered nice results recently. And I can see that momentum has outperformed value. Is this maybe some cyclical shift, or does it reflect some deeper structural changes in markets that we can say that, for example, now momentum will be better than value?
I don't think so. I mean, you never know, but in general, if you just use base rates and you look at like the past 100, 200 years of data, wherever people can actually test these ideas, maybe not obviously as good or accurately, before 1900, but people have attempted. It seems to be the case that it's very, very hard to predict when value is going to work or when momentum is going to work, because fundamentally it kind of requires you predicting human sentiment. And, as we probably know, if you've been around humans a long time, they're hard to predict. And clearly over the last 10 or 15 years, we've been in a much more kind of momentum sentiment driven market, not really a fundamentals driven market, one could argue. But the problem is, obviously if I knew that after the fact, I'd say, well, obviously we should just do all in momentum, and why are we even messing around with value, right? But I don't know in the next 15, 20 years, maybe if people only care about cash flows, net present value, like assets, that kind of thing, and momentum and sentiment just doesn't matter. If the next 10 years someone said, I know exactly what people are going to think, then I could have a better prediction. But that's why our general thought is, listen, value is a good idea, seems evergreen. Momentum is a good idea, seems evergreen. They capture two very different elements of the marketplace. I'm just going to own both of them because I can't predict when, one's going to work or one's not. Maybe other people can do that, but that's not a skill set we have.
Alpha Architect's tail risk ETF, CAOS, by the way, nice ticker, and high inflation deflation ETF, HIDE, also nice ticker. They target niche risks. How do these fit into a broader portfolio, and what investor profile are they designed for?
Yep. So we kind of look at the world like if you want to make returns, you obviously got to usually generate or you got to invest in equities, right? You got to own risk. And there we like to do cheap stocks, value stocks, obviously, or shiny rock winning stocks like momentum stocks, right? But then there's another part of the equation. What about risk mitigation and risk management? And we kind of think about the world like, okay, I have my equities over here and they're going to go crazy, lose a lot of money sometimes, make a lot of money, but it would be nice if I had things that would diversify that risk, that when they lose a lot of money, maybe these other things are doing something different, right? And then in that world, we see the world in two buckets of risk. There's fast crash risk, like, for example, like a COVID type event, or, I don't know, there's a nuclear bomb or God knows what it is, but it's like a fast crash. And then we also see kind of slow moving crashes and things like like unexpected inflation or deflation or macro events. Like they can go fast, but you kind of see some movement before you get there, right? And so CAOS is kind of what you'd expect. That's for fast crashes. So, and it's going to own basically protective puts, and we try to manage the cost to carry. So to the extent you want to protect your portfolio against a fast crash, like the market just blows up immediately, that's what CAOS is for. And then HIDE is more of a trend following approach, multi-asset trend approach, where, obviously a trend following strategy, in order for it to work, it has to have some trends. And so that's more for like the slow moving crashes where it doesn't just happen today. It might happen over a few months, but we need some trends to kind of indicate where the crash might be going. So HIDE, again, is, you balance that in your portfolio as a diversifier and help you protect against slow moving crashes. CAOS is obviously for the diversification against the fast moving crash, and how you divvy those up obviously kind of just depends on, well, what do you think the probability or the risk of a fast crash is versus a slow moving crash? And, that's how you determine the mixture in there.
So let's move now to fixed income. BOXX, BOXX. This is your 1 to 3 month BOXX ETF. And now it holds over $5 billion in assets under management. What demand gap does this product address, and how does it complement strategies like we said before, QVAL or QMOM, for example?
Yep. So this is basically, we went into the world of cash management, which is pretty boring, and there's not a lot of innovation there because people are just like, oh, just buy T-bills and call it a day, right? And so, we thought, well, what if there's a better way to do that? What if we could, it doesn't sound like a lot, but if you can earn an extra few basis points in cash, that's like tons of alpha, right? So unfortunately, like, we get happy when we make like 5 basis points more than, than the equivalent in T-bills. But in this world of cash management, that's a big deal. And so one of the things about BOXX is we innovated there in a sense that we pulled funding rates out of the option markets, where generally, at least we believe, and we've shown in revealed, performance, we think we can actually beat equivalent treasury bill duration. Right. And obviously a lot of the marketplace agrees. There's some other unique features of BOXX, but fundamentally, I think the most important thing is it's another way to capture funding rates in the short term for like the low risk cash equivalent. and and so how would that fit in a portfolio? Well, obviously, generally what happens is you want to have like your equities for like your 10-20 year horizon, try to make a lot of money, but you might lose a lot of money. And then you may have like things like CAOS or HIDE to help smooth the line out. But a lot of times people maybe have like, well, in a year from now, I need to pay for my house, or I need to pay for the tuition bill. Well, obviously you don't want to put that money in stocks or, or other things, because you can lose it all. And so that's why you need like cash and cash equivalents for these low risk, low duration needs for your capital. But you maybe want to make whatever 4 or 5% a year, which is not a lot, but that's better than zero. So that's what the use case is. And yeah, it's just a cash equivalent type instrument.
Alpha Architect recently also launched the aggregate bond ETF, BOXX, BOXA, that's the ticker. Why enter the fixed income space now, and how does BOXX's strategy align with your factor-based equity ETFs?
Yep. So our factor ETFs are different because we're applying like proprietary factors to try to beat the general equity markets, right? And that's what we're doing there. Now, BOXX and these other things, this is where we're going to leverage derivatives to try to compete in core asset classes, right? So ideally we can beat those things over long haul by just a little bit, but we're not trying to be too fancy here. It's not like factors where we're totally different than the market, and the thing's going to go way above, way below. Hopefully over the long haul, we're way above, but I can't predict that. Whereas these products are going after the core fixed income instruments, where our goal here is how can we beat this by a little bit over the long haul, and but generally we're not going to take a lot of what they call active risk. And then the other thing with BOXX and some of these other ETFs we're launching, we have elements of trend following in there where we kind of target the benchmark duration. So for example, like ag might be a 6-year duration, but in general, like if trend on ag bonds is not great, well, maybe we pull down duration to 5. And then what if trend is amazing? Maybe we pull up duration a little bit to 7, right? So we're not trying to like go crazy here, but we're just trying to do small elements of active maneuvers to try to add value and hopefully beat these broad benchmarks by a little bit, over the long haul.
So we have covered already a few ETFs. And if you were constructing a model portfolio today using just Alpha Architect ETFs, how would you allocate between value, momentum, and maybe some diversifiers like CAOS or BOXX? What would be your, let's say, a model portfolio?
Yeah. So, I mean, obviously it's going to depend on like your risk profile, but let's just take a generic 60-40. Right? Like, the normal person, they got 60% equities, and then they'd usually get put in like 40% like fixed income or diversifies or something like that. Right. So, well, if we're only using Alpha Architect stuff, obviously 60%, we would probably, just to keep it easy, just equal weight across our 4 ETFs, which are, US value momentum and then international value momentum. So that would be, just for easy math, just call it 16%, or I'm sorry, 15% in the 4 ETFs. So that'd be your 60, because we're just trying to get global factor equity exposure, well diversified. And then for the 40%, that's where things like BOXX, BOXA, HIDE, and CAOS would come into play. And there's a lot of arguments here. Personally, I would probably put, 20 to 30% of that in, a mix of CAOS and HIDE, because HIDE itself includes fixed income, but it only owns it if there's a strong trend. So let's say on that 40%, 70 to 80% of that's probably going to be just called a 50-50 mix between CAOS and HIDE to try to protect against the 2 types of crash risk. And then maybe that remaining like 10 to 20%, I would depend on what duration you want on your cash. I'd do a mix of BOXX and BOXA. And that would kind of give you a 60-40, but obviously the 60 is going to have a lot more global factor exposure. And then the 40, as opposed to just being pure fixed income, is going to be much more tail risk insurance, diversified, trend following, doing a lot more things to achieve the general goal of protecting the 60% when, when it decides to go down 50% or something crazy.
And by the way, what's your thought on passive investment? Let's say the way how John Bogle taught us. What do you think about it?
So I like or I think it's very important to keep cost and taxes down, right? So frictional cost, whether it's, trading costs, impact costs, taxes is usually a big one, at least for US investors and probably European, I imagine too. Like we've got to keep that as low as possible because no amount of alpha or activeness is ever going to work if you have crazy cost. And so that's the most beautiful thing I think about like Jack Bogle and what Vanguard does is regardless of what they're actually doing, whether it's passive, active, or anything in between, the key thing they definitely get right is they're trying to keep the cost as low as possible, both tax and frictional costs. So I'm a big believer on that. Now, let's just pretend that we're all equal on that. Let's just say everything is for free and there is no transactions cost, because clearly that matters, but let's just abstract away from that. And let's address your question of like, what do I think about passive investing versus other types of investing? Well, I think about all types of investing as the same trade-offs. And with equity in particular, I just look at the whole world as factors. And passive investing through the lens of factor investing is passive, as you know, is market cap weighted indices. So what is that? What is that right now? Well, if you're looking at market cap weighted indices, obviously from a factor perspective, you own the mega cap factor because you're obviously way overweighted mega cap stocks, clearly. You also right now own the growth factor or expensive factor, right? You're clearly not value investing. You're buying more of the more expensive securities. So your mega cap factor, your growth or expensive factor, depending on what you want to call it. And then so that's not good. Well, both of those aren't good because generally mega cap has lower returns, all else equal, than smaller caps. And then obviously cheaper stocks generally do a lot better than growth or expensive stocks on average. So you've already got two strikes against you. And then the third thing with, in general, broadly speaking, passive is usually higher quality. So that's actually good, right? So all else equal, higher quality is better than obviously junk. And in performance wise, there's a lot of arguments here, but let's just call it a wash. And in fact, it seems like actually quality stocks seem to beat low quality stocks, which is weird. But so I would say passive investing, I don't think it's good or bad or anything in between, with the cost part aside. I just think right now it's mega cap, expensive quality securities. And for me personally, I like to own cheap, smaller quality and high momentum stocks because I just believe over the long haul that's a better bet. And so that's what I do personally. And that's obviously what our products do. But if people want to do passive, that's also fine. I just think you got to be cognizant of, from a factor view, what are you actually buying? Because that's always what matters in the end.
Around 3 years ago, you publicly shared the structure of your personal investment portfolio. And I'm curious how it looks today. I mean, could you walk us through your current portfolio allocation? Specifically, what percentage do you allocate to different asset classes or strategies such as equities, bonds, and alternatives like managed futures, for example?
Yeah. So let me just preface this with I have obviously a weird situation where probably, I don't even know, 99% of my wealth is in my business. And because we have Alpha Architect and ETF Architect, and we have over $15 billion in their management. So obviously most of my wealth, I don't really get to touch it, but on paper it feels great. It's in the private asset that I just kind of write off at zero. Let's just pretend it's worth zero because whatever, it's just too complicated. But the one thing that is for sure is that is very, very exposed to beta, obviously, right? Because it's, most things that we do and operate are tied to beta. So I am very different than most people where I already have more beta exposure than I even ever know what to do with. So what my allocation here, it's going to be way more allocated to insurance, low risk, things like that than normal people should have, because I already have like a ton of equities in my private business. But generally, like I'd say on my actual money that's not in our business, just throw that away. And I haven't updated in a while, but I would say just from like a gross exposure, because I use a ton of leverage too. So I'm also weird that way. I'm probably like let's say on $100, maybe 20, 30 bucks in just straight up equities, and obviously I buy my own ETFs because I like them. So just call it like at $100, call it 20-30% like global factor equities, and then the other 70% is in managed futures, which is it's kind of like Hyde. I just do the long short version that's more complicated, but that's probably around, I don't know, 30 or 40%. And that's meant to protect against slow moving crashes. So if the market, like unexpected inflation, deflation, like a 2022, those strategies are great because they make money. And then I also have a lot of tail risk, i.e. CAOS type investment, probably for the remainder, and then cash. So let's say, 20-30% global equities. I'm talking on a gross notional basis. Probably 40-50% managed futures. And again, that's a lot bigger because, I have to have a lot of like fixed income exposure. And so it's kind of weird. And then the remainder is going to be in like chaos and just cash. Right. So again, I look weird because I'm 30% equities, let's say, and then 70% diversification, tail risk, trend fall, like things like that, because I'm trying to offset this massive equity problem or beta problem I have, where I have a ton of risk exposed in my business. So,
And this trend following part of managed futures is implemented through ETFs?
No, that's done just because we can control our own stuff and we just manage directly in the futures. It's just more efficient. Because why buy? It's also better for taxes. So,
Okay.
I mean, if your only way to access managed futures is through an ETF, then that's one thing. But obviously I can access managed futures directly because we can just run our own program. And so we don't have to pay fees and we can just buy the futures directly, and it's kind of nuanced, but it's actually more tax efficient to directly own futures than it is to do it through an ETF because of all the weird 40 Act rules.
But do you think that trend following managed futures ETFs for individual investors is it a good approach?
Yeah, so we actually created Hyde. Hyde is meant to be like low cost, simple managed futures, right? It's saying, the biggest issue with retail products, it's not even the product, it's the Jack Bogle argument, cost and taxes and fees. So we thought, hey, how are we going to do managed futures cheap? Right. And the problem with running futures in an ETF product is it's just fundamentally very expensive and technical to operate. So you can't get it cheap. Right. You're never going to, I mean, it's unlikely you're ever going to see like a really, really interesting, super complex managed futures ETF for less than 50 bips. I don't even know how, I mean, maybe over time they'll figure it out. That's why most of those products are like 80 to over 100 basis points. And that's not against the operators. It's just expensive to operate the things, right? And it's also tax inefficient. So you got to add that cost on top. So I personally think a retail client is going to be better off if they want to have kind of a managed futures type exposure. You also got to be cognizant of like the cost. And like, the problem is the costs are so high. I'm not sure the benefits are there. And so that's why we created Hyde. We're like, hey, this is not the fanciest managed futures product out there. And we admit that up front, but it's 29 basis points. So I'm starting off with like 60-70%, or 60-70 basis point advantage every year. And I feel like on net, our lack of fanciness is going to outweigh in the 70 bip cost drag, let's call it. So that's why we created Hyde. It's like managed futures for dummies, basically. But the other ones are interesting too. You just got to be really careful because the fees are very high, and also the tax drag on those can be pretty high as well.
Eugene Fama's efficient market hypothesis underpins your academic work. Yet Alpha Architect thrives on market inefficiencies, as we discussed. Is this a paradox, or do factors reconcile the two?
It depends on who you ask, right? Like depending on which professor, and they're going to argue about this for the rest of time. Some people argue, well, the reason factors kind of make money is because they're just riskier. And so from an efficient market perspective, well, if something's riskier, it should earn higher returns, right? And then obviously there's a flip side argument. Well, the reason that like certain strategies earn excess returns is because of mispricing. And the reason the mispricing exists is because it's for some other reason in the marketplace. It's really painful or hard to arbitrage, right? An example might be like value. Like, let's just pretend that value, the reason it makes earns higher returns is because of mispricing. Well, great. So is a hedge fund going to go do a long, cheap, short, expensive portfolio? No, they'd be crazy, right? Because it's so risky in the short run that you are going to go bankrupt, and it's not going to ever work as a hedge fund strategy. So even though maybe everyone knows it might be mispricing, it's not like it's easy to arbitrage because of the mechanics of the marketplace, right? So, but so the argument there, like, I don't know what the right answer is. I think it's probably a little bit of both. Like, there's probably mispricing and extra risk when you buy factors. So our objective is, how do we give people access to these factors? And we're not going to argue whether it's mispricing or risk or whatever. I don't really care. All I know is, in expectation, it probably will have higher return and higher risk. Fine. And then we're just going to make sure that, how do we deliver this as cheap and tax efficient as possible? And so if you believe like what we believe, at least you can access it in an affordable, tax efficient way.
Wes, thank you for sharing your incredible insights today, and your perspective on disciplined investing, military rigor, and so on. Before we wrap, is there anything you'd like to leave our listeners with as a final takeaway? And for those inspired by your work, where's the best place to follow your research or connect with Alpha Architect?
Best place is just alphaarchitect.com. And then we're also hang out on Twitter, or it's called X now, just at Alpha Architect. That's probably the best place to reach us directly.
All right. And do you have any closing thoughts with which you would like to keep our listeners?
No, just identify a process, whatever it is, and stick to it, and take advantage. Trust the process, and take advantage of great tools like you guys are building to do your research and do your due diligence, and hopefully make good investment decisions.
So to our audience, if you are as passionate about ETFs as we are, visit etfatlas.com, home to over 10,000 funds across the US, Canada, and Europe. And whether you're exploring factor strategies, niche themes, or Wes's quant innovations, we've got every ETF mapped. And until next time, stay curious and stay systematic. Thank you.